This is Andrew Stotz of Stotz Investment Research. And now I'm going to talk to you about the top 9 valuation mistakes and how to avoid them. Number 4 is confusing growth Capex with maintenance Capex. So let's review the 9 valuation mistakes that I've seen in my career as an analyst, but also in the Valuation Masterclass. Number 1, overly optimistic revenue forecast. Number 2, underestimating expenses causing unrealistic profit. Number 3, growing fixed assets slower than revenue. Number 4, confusing growth Capex with maintenance Capex. Number 5, forecasting drastic changes in cash conversion cycle. Number 6, underestimating working capital investment. Number 7, valuing a stock using the calculated beta. Number 8, choosing an unreasonable cost of equity. Number 9, not properly fading return on invested capital. So let's talk about confusing growth Capex with maintenance Capex. First of all, many analysts miss the relationship between Capex, depreciation, and sustainable growth. So what is Capex? Well, Capex stands for capital expenditure, and it's money that is spent acquiring fixed assets or repairing or upgrading existing assets. Of course, Capex is a long-term investment item. So if you have a jar of oil that you bought to work on a piece of capital equipment, it may be something that is necessary to keep the machine running, but it's not a long-term addition to that asset. But if you build an extension onto a production line, then that is a upgrading of an existing asset that's a long-lasting upgrade. Now, because fixed assets last longer than 1 year, Capex cost is not fully charged as an expense in the year that it's paid or incurred. So, Capex is capitalized over the life of the asset. This appears as an annual depreciation charge in the P&L, which accumulates on the balance sheet. So let's consider an example of a company that buys a $100 asset with an estimated life of 5 years. The gross value of that asset never changes. It's 100. That's what you bought it. The annual P&L depreciation charge is basically arrived at by taking the 100 divided by 5 and say every year this is going to depreciate by 20. And therefore, we can also have an accumulated depreciation that starts to build in the balance sheet. So we end up with a net asset value that's constantly falling. So if this company really wanted to, if this company wanted to grow, the problem that they would have is that this asset is basically worth nothing at the end of 5 years. Now, that's just an accounting concept. So, but in an economic sense, let's say that they were right. It is 5 years and then the machine is dead. Well, in order to make the machine last those 5 years and still produce at the same level, we would have to invest about how much? 20. If we invested 20 in that machine every year, we would offset the amount that's being depreciated. And that's the concept of depreciation. We can look at that in a little bit more detail, but let's look at the difference between change in gross fixed assets and Capex. So there's 2 Capex items in financial statements. First is the change in gross fixed assets, and the second is the Capex line in the statement of cash flows. For various reasons, these items almost never perfectly match. I've never seen it, in fact, and I have a database of almost every listed company in the world that we work on in my business as well as in the Valuation Masterclass. Well, one simple reason is that by definition, the latter, meaning the statement of cash flows, is only the cash that's being spent. So I went to visit a factory in Thailand once, and they showed me a lineup of these massive injection molding machines, and the guy told me he got 2-year credit terms for those. So that meant that the cash did not get spent in the first 2 years. So there's other reasons, but we won't go into that. That's a little more advanced. So let's look at it. Let's consider the case of Apple. Hey, since I got an Apple phone, why not? Now, in 2017, the change in gross fixed assets was $13,831 million. So we can see that difference that I just showed you down there by looking at the financial statements of Apple. Now, if we look at the 2017 change in gross fixed assets, it does not match the Capex item in the cash flow statement, which is 12,451. It's close. But there's many complicated reasons why. And in fact, accounting's so boring sometimes that I won't go into all that in this slide. So both ways of looking at Capex have value. when talking to a company's management, make sure to clarify which they're talking about. Are we talking about changing the gross fixed assets, or are we talking about the Capex amount that's going to be the cash amount that's going to be reflected in the Capex? All right, let's look at Capex across Asia. So what I've done is looked at the largest 500 companies in Asia and looked at their Capex spending in their cash flow statement. And we can see it started to come down in 2014 and 2015. But that's the total amount of Capex that the companies are spending. All right, so now let's break that into two parts. The first part is maintenance Capex. Now, we already looked at that a little bit earlier by looking at that depreciation of 20 and saying we'd have to invest 20 to offset the amount that it's depreciating. So the next one is growth Capex. Now, Coffee Works, hey, just had my espresso this morning right now. My Coffee Works espresso, the company that I own with my best friend. We've been roasting coffee with this pictured 1976 Petroncini roasting machine, coffee roasting machine, for the past 15 years. That machine is 43 years old. Now, maintenance Capex is spending to keep this existing access producing at the same level. You can imagine that an older machine like that's going to require a lot of additional work. So when we build a new part onto this machine, that would be an addition to or a Capex spending. But if you see in this slide, you'll see an oil can. When we squirt some oil on it, well, that's helping maintain the asset, but that's a short-term, less than 1 year that oil is going to be spent. So that will be expensed. Now, let's look at growth Capex. That's when you buy an additional machine, increasing your fixed assets. So what I've done is we haven't upgraded our machine yet because it works so well. But if we did, we'd probably go with the one you can see in this slide that shows 2018, the red one. And that's a fully automated, beautiful machine right there that we'd love to get. And so when we do that, we are adding a fixed asset to our business. That's for growth. Now, if we do that, of course, what would we do with the old machine? Well, we can keep it or sold. Let's get rid of it and get cash in. Let's say the new machine cost us $200 million. And let's say that the old machine we could sell for $50 million. So therefore, our net Capex amount for that year is $150. So let's look at maintenance Capex. It's for existing fixed assets. It's over time. These assets depreciate. We have to repair them. These assets must be maintained to produce the same level of revenue. Now, annual P&L depreciation charge is a good rough estimate of what must be spent to keep the asset up and running. Now, you could dispute the accounting standard related to depreciation by saying, wait a minute, Andrew, why would you depreciate something over 5 or 10 years when you have a machine that's been running for 43 years? Okay, that's the difference between economic value and accounting value. The accounting value of the machine that I showed you, our roasting machine in the factory, the accounting of that value of that is now zero. But is the economic? No. And as financial analysts, we are always looking at the economic rather than the accounting. And sometimes we'll make adjustments to the accounting to factor in the economic value. For additional growth, a company needs to invest more than just maintenance Capex. So that brings us to growth Capex, which is growth Capex for growth has much more volatility, but it's key to the future success of the company. So if we were trying to maintain our assets for the depreciation charge of 20, we would fix up the asset and have a maintenance Capex of 20. So remember this chart I showed you? Now let's play a little trick here. Same exact chart, but what I've done now is I've matched the red bar to the actual depreciation that's in the P&L, the annual depreciation charge. So we could say that there should be a maintenance Capex item that should match that depreciation charge. And you can see that depreciation charge rising over time as companies increase the assets that they have. And then you can see the remainder, therefore, is growth Capex. And that's much more volatile. In fact, in 2015, you can see that it came down quite a bit. So how to avoid the common Capex mistakes? Well, think of growth firms, first of all. Capex should be more than the annual P&L depreciation charge, maybe around 150% of it. Very high growth firms, well, Capex is probably going to be even more than 150% of depreciation. Low or no growth firms, well, they just have to maintain the value of their assets, and therefore it's matching the depreciation. So what have you learned? Well, in this session, you have learned to consider both growth and maintenance CapEx. You've learned that maintenance CapEx should be roughly the same as depreciation. You've learned that the starting point for all overall CapEx forecasting is 100% of annual depreciation charge, and that additional growth CapEx depends on how fast you expect the firm to grow. So there you have it. That was number 4, confusing growth CapEx with maintenance CapEx. Next, let's talk about forecasting drastic changes in the cash conversion cycle. See you there.